As a central bank, one of our jobs is to help make sure that the financial system, the network of banks and markets that move money around the economy for businesses and households, is safe. And a big part of this work is the Financial Stability Review, a twice-yearly health check to see how resilient the financial system is. It looks at broad factors such as economic growth, or the lack of it, inflation and debt, but also shocks such as wars and new risks such as those posed by artificial intelligence. The latest report marks the 20th anniversary of the review and comes at a particularly interesting time. The election of Donald Trump as US President has reinforced concerns about how Europe will compete in a more protectionist world. You're listening to the ECB Podcast, bringing you insights into the world of economics and central banking. My name is Paul Gordon, and I'm joined today by John Fell, who is the Deputy Director General for Macroprudential Policy and Financial Stability here at the ECB, and who works on our Financial Stability Review. He's been here before. John, thanks for joining us once again.
Thanks, Paul. It's good to be back.
So let's start with the big picture. Everywhere you look at the moment, there seems to be risk, political risk, military risk, climate risk, economic risk. Against this background, how worried should we be in Europe about financial stability?
So overall, our assessment is that sources of risk and vulnerabilities for euro area financial stability remain elevated. If we look back, 2024, I think, is going to be remembered as the biggest election year in history for the democratic world. And uncertainty about major election outcomes is now mostly resolved. But alongside geopolitical and policy uncertainty, global trade tensions are on the rise. And that gives us concerns that economic growth could be adversely affected and that inflationary pressures could be reignited. And it also increases the risk of tail events. So the cornerstone of our financial stability assessment is the identification of vulnerabilities or fault lines. This is because the impact of shocks very much depends on how resilient the financial system is. So the lower the vulnerabilities, the lower the impact. We see greater than usual potential for shocks, and we also see vulnerabilities. If I focus on the three that we're giving the greatest prominence to in this FSR, I think we can start with stretched valuations in equity and corporate bond markets, together with what we call high risk concentration. And that renders, we think, financial markets susceptible to adverse dynamics, which could be exacerbated by non-bank liquidity and leverage vulnerabilities. Now, just to explain, by high risk concentration, we mean that the financial performances of a handful of very large firms, household names, are now dominating markets. Second, heightened policy and geopolitical uncertainty in combination with weak fiscal fundamentals and sluggish trend growth are raising sovereign debt sustainability concerns in some euro area countries. And third, nascent signs of rising credit risk are becoming visible in some segments of the corporate and household sectors, which could lead to asset quality headwinds for both banks and non-banks down the road.
So we're going to look in closer detail at some of those in a moment, but let's start with inflation, because interesting point. You mentioned there that there is a risk that inflation risks become reignited, and this is part of the debate that goes around the impact of tariffs, for example. But in this latest financial stability review, the risk profile seems to have shifted a little less on inflation and more on growth, and that's that can expose us to all kinds of other risks, right?
So one can say that growth is fundamental for financial stability. I think one just has to look at the scenarios which are routinely designed for EU-wide banking sector stress tests, the ones that the EBA coordinates. They almost always involve a sizable contraction of economic activity. So why is that? Now, why is economic growth important for financial stability? Well, if I look at it from the positive side, first, it improves credit worthiness as it enhances the financial health of businesses and households, and that will reduce the risk of loan defaults, and that will in turn strengthen the banking sector. Second, it increases resilience because A growing economy generates higher income and savings, and that allows for the creation of, let's say, call them buffers to be built against rainy days. And then third, economic growth can enhance fiscal capacity. So by here we mean by improving government revenues, it can strengthen fiscal positions, and then that can ensure that backstops are available to protect financial systems during financial crisis. One only has to think about the support that governments were able to provide to businesses and households during the pandemic, I think, to have an understanding of the importance of this. So with that background, one of the reasons we have concerns now about downside risk to growth is because of the challenges facing many euro area governments. Sovereign debt GDP ratios have come down. They've come down significantly since the pandemic, but many countries still have large primary deficits. And then, if we look forward, many are going to will need to boost investment to address longer-term challenges. So that the list here is long: greening and digitalizing their economies, raising defence spending, and managing demographic change, just to name a few. And a concern here is that growth potential in the euro area has halved since the 1990s. We have a chart in the FSR showing that. And all else equal, this works against debt sustainability. And I think it also really underscores the importance of the Draghi report recommendations to enhance European competitiveness and economic resilience. So maybe putting it another way, navigating conflicting objectives between stabilizing public finances and making necessary investment would be a lot easier if potential growth was higher.
Yeah, this is a source of a great deal of concern at the moment in Europe, isn't it? The potential growth, the rate at which the economy can grow is weak. Productivity is weak, and this is a problem in many parts of the world. But Europe is clearly, the data clearly shows Europe falling behind the US quite significantly. And this is why these reports were commissioned, the Mario Draghi report, the Enrico Letta report as well. What role does finance have in all of this?
So, we have a special feature in this issue which looks at the role that finance has played in the allocation of capital across firms. So just very basically, if capital is allocated inefficiently, that can reduce the productive capacity of the economy, and that can subdue growth. Now, if we focus on this aspect, the analysis compares the productivity of firms financed by banks with those financed by non-bank financial intermediaries. And it finds that euro area firms rely heavily on bank loans. That's not a new finding. But it also finds that banks tend to avoid lending to firms which have, say, high intensity of intangible assets or hard to collateralize assets on their balance sheets. These will be characteristics, for instance, of IT startups. They often have intangibles, for instance. And the hesitation could be because banks face the possibility of losing all of their investment if a firm fails. And then their upside is capped if a firm succeeds. They will only get the loan plus interest back, not a share in the profits. Now, being able to seize tangible assets in case of a failure may moderate their risk aversion. And that might explain why they have a preference for financing less risky businesses. Or it might simply reflect a lack of skills required to evaluate unproven or early stage technologies. But the upshot is that bank credit has been directed more towards sectors where productivity is low, especially the real estate sector, and also wholesale and retail trade. Now, maybe even more strikingly, when we look at individual sectors, we see a systematic tendency for euro area banks to lend to less productive firms within those sectors. Firm productivity is lower across the board, in fact, for firms relying on bank loans, regardless of which sector we look at. And that finding doesn't depend on firm size either. When you have economies of scale, we would expect larger firms to be more productive than small ones, but we're still finding that banks are funding less productive large firms than non-bank financial intermediaries are. Now, while that's not entirely a new finding. These findings suggest that one of the reasons for the productivity gap between the euro area and the US is the greater variety of funding options available to US firms. So more generally, I think it supports the case that a genuine capital markets union needs what I would call an ecosystem of venture capital markets together with deep, liquid and integrated equity markets. With more financing options, firms will be able to structure their funding in ways that are better suited to their business life cycle stage. So if innovative firms have the ability to tap venture capital for funding, that would create the potential for boosting the productivity of those euro area firms that are not getting financing from banks. But that would require that venture capital investors who specialize in funding businesses at an early stage of their life cycle have confidence in their ability to exit those investments into the equity markets before growth slows down.
So this is a repeated call, of course, by the ECB and others for a capital markets union. It's been slow going so far. As I mentioned, we're in something of a new era now, so maybe that will change. Let's take a look at the markets, though, as a financial stability risk. Now, after the election of Donald Trump in the US, stocks, the dollar, cryptocurrencies, they all surged. While we're recording this podcast, the markets may or may not be toppy. I mean, I can't predict the market any better than anybody else, but they've come off their highs, that's for sure. But the key thing here is, as you've mentioned, Europe does need to use markets. People need to invest rather than just put their money in the bank and earn the deposit rate at the bank. And some are doing so, that's true. In your report, though, you look at one key risk, and I don't want to overestimate this, but there is a risk there, which is the rise of passive investing in equity markets, so exchange-traded funds, tracker funds. What did you find?
So let me be clear that we're not warning that passive investing, so that's where investment is made in funds or instruments which track broad market indices. We're not saying that that's inherently risky for an individual investor. For non-professional investors who lack either the time or the skills for stock picking, say, passive is often the preferred approach. And that's because instruments such as index ETFs have many benefits, diversification benefits, and they track broad indices like the S&P 500 or the Euro stocks. They're also cost and tax efficient, charging lower fees than active funds who are aiming at beating the market but then charge more because of that expected or hoped for outperformance, and their turnover is lower as well. But maybe most importantly, after fees, they perform more often than not better than active funds. And study after study has shown this. Passive, over the long run, beats active. Now, that out of the way, our concerns are about the impact on market functioning of structural changes that we see taking place in the balance of passive versus active investors in the market. So, in box 3 of the review, we document global passive equity funds' net assets surpassing those of active counterparts for the very first time in 2023. And that raises fundamental questions about how market efficiency and market stability are being affected. In finance, so-called efficient market theory would contend that asset prices reflect all publicly available information all of the time. An implication of that being that analysing business fundamentals is not necessarily a useful endeavour. Now, Warren Buffett, a legendary active investor, has written in letters to his shareholders that in any sort of contest, be it financial, mental or physical, that it's an enormous advantage to have opponents who have been taught that it's useless to even try. So in other words, if markets are inefficient some of the time, it allows active investors to profit from the mistakes of passive, restoring prices to fundamental values. But the question then is, what happens when there are fewer and fewer active investors in the market? Will markets still have the capacity, for instance, to self-correct in this way? that I described. So looking into this question, box 3 contains empirical analysis which shows that as the proportion of passive investment funds rises, correlations among stocks rise too, and so does concentration of market capitalization. And this is what we have seen. We've seen exactly this in the US, where equity market capitalization is now more concentrated than ever before among a handful, or maybe a handful and a half, of single names, the so-called Magnificent Seven stocks. Now, as these trends continue, vulnerabilities to the risks of individual firms rise. So what the earnings releases of those firms can have volatility impacts. But we also worry about the possibility that may make markets more prone to volatility, the sources of volatility increase, and also overshooting, both on the upside and the downside, if there isn't a sufficient number of active investors to correct, exuberance. So the volatility spike that we witnessed last August, which we discuss at length in the FSR, we think that may have been symptomatic of these trends.
So everyone's running in the same direction at the same time. Things can go wrong badly when they go wrong. One to watch. Now, we mentioned at the start of the episode that the Financial Stability Review has been running for 20 years. So congratulations. It makes it a good moment to step back and see if it's achieving its goal, which is not to avoid financial crisis. That would be nice, but they have happened in the past 20 years, of course. But to warn the respective authorities, whoever, financial markets, so they can be ready, so they can be prepared. How's it done?
Well, to mark this 20th anniversary, we thought it was high time to carry out a kind of post-mortem of the effectiveness of the FSR in its communication objectives. So to do this, we looked at the how have we done question from a number of angles. One was through a survey of our readers, 86 of whom responded. I'm told this is a decent number for a survey of this kind. And I think it confirms that we have a fairly broad readership. The majority come from central banks and the financial industry, but we also saw responses from other fields like academia, international organizations, and the media. And when it was launched 2 decades ago, I think it's important to put to recall the context. There was no macroprudential policy framework, so that basically meant that we had no policy tools to prevent financial crisis. So that meant we put a lot of faith was put into the ability of communication to inform, to influence, and perhaps even prevent financial crisis. On these basic objectives, I think the findings have positively surprised us. First, most of our readers say that we have been identifying relevant issues over time, but some think that we may have a tendency to overstate the relevance of risks. Second, our readers say the FSR influences decision making, not only on policy and research, where we might have expected that we may have had some influence, but also on risk management, so crisis preparedness. Unsurprisingly, we don't appear to have much influence on investment decisions. But if I come directly to your question, how have we been able to predict financial crisis, or have we been able to, with sufficient notice, to add value in making financial institutions crisis prepared? So using natural language processing techniques, we looked at how the sentiment of the language used in the FSR had leading indicator properties. And it turns out that sentiment has tended to turn noticeably negative about a year in advance of systemic stress episodes. So it looks like the FSR has been a source of early warning findings, a finding that I hope will keep our existing readers motivated and maybe encourage new ones to start reading the FSR.
Okay, well, let's hope they continue with that vein for the next 20 years and longer. John, thank you very much indeed. But we're not done. As we approach the end of the episode, we have a standard question for all of our guests, and that is on a hot tip linked to the topic we're discussing today, so on the Financial Stability Review. Do you have one today?
I do, and this time I have a book recommendation. I thought it particularly apt for making sense of the changes and challenges that we're witnessing in the world. It's a book by Ray Dalio. It's called Principles for Dealing with the Changing World Order. And I think among the many valuable messages that are contained in it, Dalio emphasizes the importance of adaptability, seeing it as essential both for countries and individuals, and I suppose also firms in a constantly changing world.
Okay. He came on to this idea of writing a book when he noticed a confluence of events, right? It was inequality in wealth, political and social conflicts, a high debt, and the last time he saw this confluence of events was the 1930s. So
it was.
Yes, let's hope things turn out better this time. John, thank you very much indeed. That brings us to the end of this episode. It's been great talking to you. Listeners, if you want to read the full Financial Stability Review, do check out our show notes where we'll link the report for more information on the topic. You've been listening to the ECB Podcast. I'm Paul Gordon. If you like what you've heard, of course, please subscribe. Please leave us a review. And in the spirit of Europe, wish me well here, John, we're going to end in Latvian and say, Uz Vedašanos. Farewell.